Hello, everybody. Thanks for joining. It's our first webinar for 12 months on the multi-asset income strategy, and I'm pleased to say the performance has been good. This year, we're 8% up in dollars, and market conditions have turned more favorable, as you will hear. The call will be led by Jean-Yves and Charles. I need to tell you that our multi-asset RAIF fund is only for well-informed investors. We've had some good questions. Please do send more, and I'll now hand over to Jean-Yves.
Thank you, Sandy, and thank you all for attending this second event of the multi-asset income strategy. Let me first start by reminding everybody of the main objective of this fund. One of the main objectives is the generation of an attractive income, as you can see on the left-hand side, around 4% per annum, and this year is no exception, with 2% generated as of the end of May. The second objective is the potential to generate capital appreciation, and capital appreciation is generally generated by the income portion of the portfolio. And as you can imagine, this year has been very fruitful, and with the equity portfolio up around 14%, 13.7% specifically, at the end of May, and even more at the end of where we are now in June. The third objective is to achieve a below average volatility. As you can imagine, over the past 12 months, volatility has increased. However, we are getting on this year, and we are actually now almost on target. However, despite this, the strategy is still achieving volatility close to half that of the equity markets. Finally, the main objective is to generate, as you can imagine, 6 to 8% per annum over the cycle. Following the correction that took place in 2022, the recovery is well on its way. As you can see on the next slide, the portfolio so far this year is up 8.5%. That is a 5.2 annualized rate of return net of fees since inception in January 2015. So a good recovery ahead of the benchmark. Also, and most importantly, the performance so far this year has been driven by the equity portion of the portfolio. The fixed income and the alternative investment have so far been more subdued, which in our view is very encouraging for the rest of the year, especially for the fixed income contribution. So what have we done since last year? As you recall, the strategy is dynamically managed. And what this means is that we can change the allocation between asset classes and within the asset classes. After a very strong performance for equities during 2021, we decided to reduce the exposure to this asset class and did it further in 2022. Towards the end of 2022, following the correction, we felt that it was right to increase the exposure again. And with the strong performance of equities year to date, the portion of this asset class increased again, and therefore we decided to reduce the exposure to what we perceived as a current appropriate risk reward. More importantly, the fixed income assets, which has lagged the other assets, present currently a very attractive potential, which we intend to capture for our clients, and Charles will demonstrate it. This led to our change in asset allocation that took place since the beginning of this year. The sole purpose of this change is to enhance the performance, and reduce risk. In June 2022, the strategy had a classic asset allocation with 35% exposure to equities, 45% to fixed income, and around 20% to non-correlated assets, with the target that we mentioned before of 6 to 8% per annum return, net of fees. This return may differ depending on the relative attractiveness of potential for return of each asset class relative to each other's. As equities perform very strongly, as already mentioned, since the start of the year, and certainly beyond our expectation considering the environment, we decided to reduce the exposure to what is now around 30%. 55% are now invested more or less in fixed income and 15% in non-correlated assets. But as a result, because the potential for a return from the fixed income has increased substantially, we now believe that we can achieve 9 to 10% per annum return net of fees. As for the asset allocation within the asset class, there's been little changes, and the diversification by geography and sector has remained roughly the same for both equities and fixed income. The main changes for the fixed income standpoint has been really the increase in higher quality bonds, as the increase in interest rate during 2022 has put pressure on prices and therefore gave us the ability to buy some of those bonds well below par. More noticeable within the non-correlated asset class has been the shift away from trade finance funds, as some of those are still dealing with the aftermath of the COVID pandemic and are being currently unwound, with cash coming back to investors as loans reach maturity. We decided to redeploy the capital to some direct lending transactions, which we are managing internally, totally non-correlated to the market and with attractive potential for return now that interest rates globally have increased by around 500 basis points. To give you a quick flavor of the trading activity so far this year, please find here some examples for the equity. Without going into too much detail, we have taken profit on some of the equities that performed very well over the last 2 years. And as an example, Schlumberger is at the forefront of that, especially considering the uncertainty for economic growth and as well the correction in oil prices. Beside that, Thermo Fisher and Diageo, which for different reasons found themselves in a more challenging environment, especially for Diageo, which has more exposure to North America and less exposure to China, so potentially see less growth for the coming short term. As mentioned, the quality of the portfolio from a credit standpoint has improved, and that is really expressed here. As you can see, some of the sales are single B from a credit standpoint, and we increase the portion of double Bs and above. And some of the examples here are very symptomatic of what happened in the market. And if you look at the top, Coca-Cola Szekek is actually one of the top quality within our universe, and Charles will expand on that. Again, share price under pressure because of the interest rate, but again, great opportunity for us to buy those. And at the other end of the spectrum, we have a couple of Turkish names which we decided to lighten essentially ahead of the elections in the country. Next, one of the key issues of investors' mind, is about whether the expected economic slowdown, combined with resilient but subsiding inflation, could have an impact on corporate earnings. Amazingly, so far this year, earnings for equities overall have been quite solid and even better for our portfolio. As you can see on this slide, the picture is well balanced with a mix of upgrades and downgrades for an average upgrade of roughly 2%. Signs from our holdings are that despite a more challenging environment, their prospects are still very good. Now, I will pass it on to Charles for the fixed income portion.
Thank you, Jean-Yves. So yes, I can just take us on to our fixed income component of the strategy and just delve into that in a bit more detail. And I think the first thing to look at really is the income generating capacity of our portfolio companies. You can see there with the blue line, the cash generated by each of the portfolio companies that we're holding. And this really is, delivering on the key objective of delivering that income yield to the overall strategy. The pink bars show the movement in bond prices, which is the other component of the total return for the portfolio. And you can see there that there are there's been some pressure on some of the bond prices due primarily to the rise in interest rates, which Jean-Yves touched on earlier. However, I think it's important to point out that we have a relatively short dated portfolio. So the average duration on the portfolio is just under 4 years. And you can see there that the average bond price right now is just over 81 cents on the dollar. So what that means is that there is a significant opportunity for some capital appreciation over the short term as we see these bonds tend to maturity, and we see the bond prices therefore increase as they get redeemed at par. And if we just move on, I think given, we've been allocating slightly more to the fixed income component, I think it's important to touch on a couple of subjects. Firstly, default rates. And if we look at default rates across the US, across Europe, you can see that default rates are currently at historic lows. And then, you can see there the pink bar, which is the emerging market default rates. They look high, but when you exclude two idiosyncratic areas in the names of Russia and Chinese property, then default rates are considerably lower in line with that of the developed world. So as I say, we're starting from a very good point to these historically low default rates. And then on the right-hand side, I think it's good to look at valuations. And what this graph shows is that if we look at the corporate credit spread per turn of leverage, we're actually at a good point, and we're being compensated for the level of risk that we're taking in the balance sheets that is actually higher than what it has been at a historical level. So we think, again, this is a good opportunity and a good entry point given from a valuation standpoint. Then maybe just moving on to one of the companies which we've invested in recently, which Jean-Yves touched on. So this is Coca-Cola İçecek, which is a beverage company operating in Turkey and 10 countries, primarily throughout the Middle East. It's the exclusive bottler and distributing partner of the Coca-Cola Company. And we like this business for a number of reasons. One, we like the geographic diversification. We like its market-leading position, its strong brand recognition, its solid track record of growth driven by the demographics, the increasing purchasing power, the westernization of, and the demand for the types of products which are on offer. And at the same time, we really like the balance sheet, given it's very prudent. You can see there at the bottom right-hand corner, very low leverage, very high interest cover, great liquidity. And again, we think this is just an extremely high quality business. And at the same time, we decided to invest in this business. We were able to achieve a close to 8% yield for a bond that matures in just over 1 year's time. So again, these are the types of opportunities which we're seeing, and we think are just very attractive from a risk reward point of view. Then if we move on, another company that we've invested in recently is Cemex. So this is one of the leading building materials companies in the world with operations in over 50 countries. The company is currently benefiting from the nearshoring trends in its key markets in Mexico. It's also benefiting from stimulus growth in the US. And what that means is that this business is generating a lot of free cash flow. It has no major refinancing issues in the near term. It's in the process of deleveraging, and the company have made it a key focus of theirs to target this investment grade credit rating. So that's all great from an operational point of view. But what's important to point out is, given the repricing of broader interest rates, what that means in terms of where the company is able to issue bonds. And you can see that if we look back at June 2021, this company issued bonds at just over 5%. If we fast forward 18 months, we're now the company, which arguably is in better shape from a fundamental perspective, is now issuing bonds at just over 9% for similar seniority, same credit rating, and similar maturities. So what we did is we bought this bond close to par, and we're going to generate just over 9% for the next 5 years when this bond is then matures in 2028. So again, this is just the type of opportunity which we're seeing, which we think is very, very attractive. And it's these coupons which I think will be a trend as part of the broader market, which we'll be able to tap into more as further companies issue at similar levels. And with that, I'll pass it back to Jean-Yves.
Thank you, Charles. Just to finish the presentation, just a quick word about the outlook. Clearly, central banks are totally focused on bringing inflation under control. It is clear that inflation is subsiding almost everywhere, but it is also clear that core inflation might be somewhat more difficult to bring to those banks' levels or targets around the 2% level. And as well, it is unclear how long it will take. Job market in the US, but as well elsewhere, is indeed extraordinarily strong and resilient. This could also create some extra inflationary pressures, as we've seen over the past few days, for example, in the UK. The global economic growth is slowing down, but it is so far a very gradual process. So the clear question on people's mind is whether it will turn into a full-blown recession, and when it will take place, as well as the potential impact on earnings. This is a macro point, and as you know, we don't do macro at GESTERN. What our companies are telling us so far is that the environment is more challenging, but they are confident that they can weather the storm if a storm there is. A big disappointment this year is China. There was a lot of hope that with the reopening of the Chinese economy in February, March this year, demand will instantly react. This didn't quite happen, but local authorities, as well as the central government, are taking measures to boost the economy. We are very constructive about the Chinese economy over the mid to long term. Valuation is always a debatable subject, and people have different views about it. But there are times where there are clear pockets of undervaluation and clear opportunities. And this is what we are seeing at the moment with our emerging market corporate debt strategy, and that is in hard currency. We believe that there is a great possibility to make money for our investors, and this is why we are reallocated more money to that asset class. One last point is the chart on the right-hand side, which is about yield compression. Another big question mark in investors' mind is whether it is worth taking more risk at this juncture to achieve the same result. As treasury yields, corporate investment grade yields, and the S&P 500 earnings yield have all converged to the same level. We think that it is worth reflecting on this. This is why we have adjusted our asset allocation, as I just mentioned, and could adjust it further if necessary. Yields are back, and we will make the most of it. To conclude, we are constructive about this year, and as well as for the mid-long term, as we feel that the multi-asset income strategy provides a perfect balanced solution for income and total return with low volatility in an environment which is not getting easier to navigate. Investing for the long term, do your own research, and invest only in quality still remain the key pillars of what we do at GESTERN.